Welcome back, guys. Our subject is Es6 Engineering Economics, and this is Lecture 3. So we are still under Chapter 1, Introduction to Engineering Economics. Our lesson for today is Cost Concepts for Decision Making. Let's first discuss cost terminology. First, we have fixed costs. Fixed costs are those unaffected by changes in activity level over a feasible range of operations for the capacity or capability available. Typical fixed costs include insurance and taxes on facilities, general management and administrative salaries, license fees, and interest costs on borrowed capital. Of course, any cost is subject to change, but fixed costs tend to remain constant over a specific range of operating conditions. When larger changes in usage of resources occur, or when plant expansion or shutdown is involved, fixed costs can be affected. Next is variable costs. Variable costs are those associated with an operation that varies in total with the quantity of output or other measures of activity level. For example, the cost of material and labor used in a product or service are variable costs because they vary in total with the number of output units even though the cost per unit stay the same. Incremental cost. Incremental cost is the additional cost that results from increasing the output of a system by one or more units. Incremental cost is often associated with go-no-go decisions that involve a limited change in output or activity level. For instance, the incremental cost per mile for driving an automobile may be 49 cents, but this cost depends on considerations such as total mileage driven during the year, mileage expected for the next major trip, and the age of the automobile. Also, it is common to read about the incremental cost of producing a barrel of oil and incremental cost to the state for educating a student. As these examples indicate, the incremental cost is often quite difficult to determine in practice. We have example 2-1, fixed and variable cost. In connection with surfacing a new highway, a contractor has a choice of two sites on which to set up the asphalt mixing plant equipment. The contractor estimates that it will cost $2.75 per cubic yard mile to haul the asphalt paving material from the mixing plant to the job location. Factors relating to the two mixing sites are as follows. Okay, so we have the average hauling distance for site A, 4 miles, for site B, 3 miles. The monthly rent of site, $2,000 for site A, $7,000 for site B. Cost to set up and remove equipment, $15,000 for site A, $50,000 for site B. Hauling expense, $2.75 per cubic yard mile, site A, and for site B is the same. For plug person, not required in site A, and $150 per day for site B. The job requires 50,000 cubic yards of mixed asphalt paving material. It is estimated that 4 months will be required for the job. Compare the two sites in terms of their fixed, variable, and total cost. Assume that the cost of the return trip is negligible. Which is the better site? For the selected site, how many cubic yards of paving material does the contractor have to deliver before starting to make a profit if paid $12 per cubic yard delivered to the job location? Okay, so here is the solution. The fixed and variable cost for this job are indicated in the table shown next. Site rental, setup, and removal cost would be constant for the total job, but the hauling cost would vary in total amount with the distance and thus with a total output quantity of cubic yard miles. Okay, so shown in the table, yung mga fixed cost natin are the rent, setup or removal, and plug person. While yung variable cost natin is yung hauling. Kasi yung hauling nakadepende sa hauling distance. Site B, which has the larger fixed cost, has the smaller total cost for the job. Note that the extra fixed costs of Site B are being traded off for reduced variable costs at the site. The contractor will begin to make a profit at the point where total revenue equals total cost as a function of the cubic yards of asphalt pavement mix delivered. Based on Site B, so we have X equal to 24,200 cubic yards delivered. Therefore, by using Site B, the contractor will begin to make a profit on the job after delivering 24,200 cubic yards of material. By going back to the cost terminology, we have direct costs. Direct costs are costs that can be reasonably measured and allocated to a specific output or work activity. The labor and material costs directly associated with a product, service, or construction activity are direct costs. For example, the materials needed to make a pair of scissors would be a direct cost. Indirect costs. Indirect costs are that are difficult to allocate to a specific output or work activity. Normally, they are costs allocated through a selected formula to the outputs or work activities. For example, the cost of common tools, general supplies, and equipment maintenance in a plant are treated as indirect costs. Standard costs are planned costs per unit of output that are established in advance of actual production or service delivery. They are developed from anticipated direct labor hours, materials, and overhead categories. Standard costs play an important role in cost control and other management functions. Some typical uses are the following. Number 1, estimating future manufacturing cost. Number 2, measuring operating performance by comparing actual cost per unit with standard unit cost. Number 3, preparing bids on products or services requested by customers. And number 4, establishing the value of work in process and finished inventories. Next, we have cash cost. A cost that involves a payment of cash is called a cash cost. Cash costs are estimated from the perspective established for the analysis and are the future expenses incurred for the alternatives being analyzed. Next is book cost. A cost that does not involve a cash transaction and is reflected in the accounting system as a non-cash cost or a book cost. Book costs are costs that do not involve cash payments but rather represent the recovery of past expenditures over a fixed period of time. The most common example of a book cost is the depreciation charge for the use of assets such as plant and equipment. In engineering economic analysis, only those costs that are cash flows or potential cash flows from the defined perspective for the analysis need to be considered. Depreciation, for example, is not a cash flow but is important in an analysis only because it affects income taxes, which are cash flows. Next is sunk cost. A sunk cost is one that has occurred in the past and has no relevance to the estimates of future costs and revenues related to an alternative course of action. Thus, a sunk cost is common to all alternatives, is not part of the future cash flows, and can be disregarded in an engineering economic analysis. For instance, sunk costs are non-refundable cash outlays such as earnest money on a house or money spent on a passport. Sunk costs are irretrievable consequences of past decisions and therefore are irrelevant in the analysis and comparison of alternatives that can affect the future. Okay, so here is example 2-2. Sunk cost in replacement analysis. A classic example of sunk cost involves the replacement of assets. Suppose that your firm is considering the replacement of a piece of equipment. It originally cost $50,000 and is presently shown in the company records with a value of $20,000 and can be sold for an estimated $5,000. For purposes of replacement and analysis, the $50,000 is a sunk cost. However, one view is that the sunk cost should be considered as the difference between the value shown in the company records and the present realizable selling price. According to this viewpoint, the sunk cost is $20,000 minus $5,000 or $15,000. Neither the 50,000 nor the 15,000, however, should be considered in an engineering economic analysis, except for the manner in which the $15,000 may affect income taxes, which will be discussed in the succeeding chapters. Okay, going back to cost terminology, we have opportunity cost. An opportunity cost is incurred because of the use of limited resources, such as that the opportunity to use those resources to the monetary advantage in an alternative use is forgone. Thus, it is the cost of the best rejected opportunity and is often hidden or implied. Consider a student who could earn $20,000 for working during a year but chooses instead to go to school for a year and spend $5,000 to do so. The opportunity cost of going to school for that year is $25,000, $5,000 cash outlay, and $20,000 for income forgone. Okay, so we have another example, example 2-3. Opportunity cost in replacement analysis. The concept of an opportunity cost is often encountered in analyzing the replacement of a piece of equipment or other capital asset. Let us reconsider example 2-2 in which your firm considered the replacement of an existing piece of equipment that originally cost $50,000 is presently shown on the company records with a value of $20,000 but has a present market value of only $5,000. For purposes of an engineering economic analysis of whether to replace the equipment, the present investment in that equipment should be considered as $5,000 because by keeping the equipment, the firm is giving up the opportunity to obtain $5,000 from its disposal. Thus, the $5,000 immediate selling price is really the investment cost of not replacing the equipment and is based on the opportunity cost concept. Going back to cost terminology, we have life cycle cost. Life cycle cost refers to a summation of all costs related to a product, structure, system, or service during its lifespan. It is a time horizon that must be defined in the context of the specific situation, whether it is a highway bridge, a jet engine for commercial aircraft, or an automated flexible manufacturing cell for a factory. Okay, so we have figure 2-1, the phases of life cycle and their relative cost. Okay, so we now go to decision making. Decision making may take place by default. That is, a person may not consciously recognize that an opportunity for decision making exists. This fact leads us to a first element in a definition of decision making. To have a decision making situation, there must be at least two alternatives available. If only one course of action is available, then there can be no decision making. for there is nothing to decide. There is no alternative but to proceed with the single available course of action. At this point, we might conclude that the decision-making process consists of choosing from among alternative courses of action. But this is an inadequate definition. Consider the following. At a racetrack, a bettor was uncertain about which of the 5 horses to bet on in the next race. He closed his eyes and pointed his finger at the list of horses printed in the racing program. Upon opening his eyes, he saw that he was pointing to a horse number 4. He hurried off to place his bet on that horse. Does the racehorse selection represent the process of decision making? Yes, it clearly was a process of choosing among alternatives. But the particular method of deciding seems inadequate and irrational. We want to deal with rational decision making. Kasi dito sa engineering economy, dapat rational decision making yung gawin nating process. Kasi dapat scientific or may basis tayo on choosing an alternative. Rational decision making. Rational decision making is a complex process that contains 9 essential elements, which are shown sequentially in figure 1-1. Although these 9 steps are shown sequentially, it is common for the decision making to repeat steps, take them out of order, and do steps simultaneously. For example, when a new alternative is identified, then more data will be required. Or when the outcomes are summarized, it may become clear that a problem needs to be redefined or new goals established. The value of this sequential diagram is to show all the steps that are usually required and to show them in a logical order. Occasionally, we will skip a step entirely. For example, a new alternative may be so clearly superior that it is immediately adopted at step 4 without further analysis. The following sections describe the elements listed in figure 1-1. Okay, so here is figure 1-1. We have one possible flowchart for the decision process. So each of these steps ay i-discuss natin dito sa ating lecture. Step 1, recognize the problem. The starting point in rational decision making is recognizing that a problem exists. Some years ago, for example, it was discovered that several species of ocean fish contained substantial concentrations of mercury. The decision-making process began with this recognition of a problem, and the rush was on to determine what should be done. Research revealed that fish taken from the ocean decades before and preserved in laboratories also contained similar concentrations of mercury. Thus, the problem had existed for a long time but had not been recognized. Step 2. Define the goal or objective. The goal or objective can be a grand overall goal for a person or a firm. For example, a personal goal could be to lead a pleasant and meaningful life, and the firm's goal is usually to operate profitability. The presence of multiple conflicting goals is often the foundation of complex problems, but an objective need not to be a grand overall goal for a business or an individual. It may be quite narrow and specific. I want to pay off a loan on my car by May, or the plant must produce 300 golf carts in the next 2 weeks, are more limited objectives. Thus, defining the objective is the act of exactly describing the task or goal. In typical situations, recognition is obvious and immediate. Step 3. Assemble relevant data. To make a decision, one must first assemble good information. In addition to all published information, there is a vast quantity of information that is not written down anywhere but is sorted as individuals' knowledge and experience. There is also information that remains ungathered. A question like how many people in your town would be interested in buying a pair of left-handed scissors cannot be answered by examining published data or by asking any one person. Market research or other data gathering would be required to obtain the desired information. Market research or other data gathering would be required to obtain the desired information. From all this information, what is relevant in a specific decision-making process? Deciding which data are important and which are not may be a complex task. The availability of data further complicates this task. Some data are available immediately at little or no cost in published form. Other data are available by consulting with specific, knowledgeable people. Still, other data require surveys or research to assemble the information. Some data will be of high quality, that is, precise and accurate, while other data may rely on individual judgment for an estimate. If there is a published price or a contract, the data may be known exactly. In most cases, the data is uncertain. What will it cost to build the dam? How many vehicles will use the bridge next year or in year 20? How fast will a competing firm introduce a competing product? How will demand depend on growth in the economy? Future costs and revenues are uncertain, and the range of likely values should be part of assembling relevant data. The problem's time horizon is part of the data that must be assembled. How long will the building or equipment last? How long will it be needed? Will it be scrapped, sold, or shifted to another use? In some cases, such as for a road or a tunnel, the life may be centuries with regular maintenance and occasional rebuilding. A shorter time period, such as 50 years, may be chosen as the problem's time horizon so that decisions can be based on more reliable data. In engineering decision making, an important source of data is a firm's own accounting system. This data must be examined quite carefully. Accounting data focuses on past information, and engineering judgment must often be applied to estimate current and future values. For example, accounting records can show the past cost of buying computers, but engineering judgment is required to estimate the future cost of buying computers. Financial and cost accounting are designed to show accounting values and the flow of money, specifically costs and benefits, in a company's operations. Where costs are directly related to specific operations, there is no difficulty, but there are other costs that are not related to specific operations. These indirect costs or overhead are usually allocated to a company's operations and products by some arbitrary method. The results are generally satisfactory for cost accounting purposes but may be unreliable for use in economic analysis. To create a meaningful economic analysis, we must determine the true differences between alternatives, which might require some adjustment of cost accounting data. Okay, so we have example 1-1. The cost accounting records of a large company show the average monthly cost for the three-person printing department. The wages of the three department members and benefits, such as vacation and sick leave, make up the first category of direct labor. The company's indirect or overhead costs, such as heat, electricity, and employee insurance, must be distributed to its various departments in some manner, and like many other firms, This one uses floor space as the basis for its allocation. So we have direct labor, 6,000, materials and supplies consumed, 7,000, allocated overhead cost, we have 200 square meter of floor area at $25 per square meter, amounting to 5,000, and a total of $18,000 of cost. The printing department charges to other departments for its services to recover its $18,000 monthly cost. For example, the charge to run 30,000 copies for the shipping department is, for direct labor, we have $228, materials and supplies, $294, and overhead cost, we have $291. So the cost to other departments is $793. The shipping department checks with a commercial printer which would print the same 30,000 copies for $688. The shipping department foreman wants to have the work done externally. The in-house printing department objects to this. As a result, the general manager has asked you to study the situation and recommend what should be done. Okay, so here is the solution. Much of the printing department's output reveals the company's cost, prices, and other financial information. The company president considers the printing department necessary to prevent disclosing such information to people outside the company. The firm cannot switch to an outside printer for all needs. A review of the cost accounting charges reveals nothing unusual. These charges made by the printing department cover direct labor, materials and supplies, and overhead. The allocation of indirect cost is customary procedure in cost accounting systems, but it is potentially misleading for decision making, as the following discussion indicates. The shipping department would reduce its cost by $105 by using the outside printer. In that case, how much would the printing department cost decline, and which solution is better for the firm? We will examine each of the cost components. Okay, so for direct labor, if the printing department had been working overtime, then the overtime could be reduced or eliminated. But assuming no overtime, how much would the saving be? It seems unlikely that a printer could be fired or even put on less than a 40-hour work week. Thus, although there might be a $228 saving, it is much more likely that there will be no reduction in direct labor. Kasi yung printer, machine siya, hindi siya manpower. So, hindi mo siya pwedeng i-fire or bawasan yung 40-hour work week niya. Kasi lagi lang naman siyang nasa office. Materials and supplies. There would be 294 saving in materials and supplies. For allocated overhead cost, there will be no reduction in the printing department's monthly $5,000 overhead, and in fact, the firm will incur additional expenses in purchasing and accounting to deal with the outside printer. The firm will save $294 in materials and supplies and may or may not save $228 in direct labor if the printing department no longer does the shipping department work. The maximum saving should be 522. Either value of 294 or 522 is less than the 688 the firm would pay the outside printer. For this reason, the shipping department should not be allowed to send its printing to the outside printer. Gathering cost data presents other difficulties. One way to look at the financial consequences, costs, and benefits of various alternatives is as follows. Market consequences. These consequences have an established price in the marketplace. We can quickly determine raw material prices, machinery cost, labor cost, and so forth. Extra market consequences. There are other items that are not directly priced in the marketplace, but by indirect means, a price may be assigned for these items. Examples might be the cost of an employee injury or the value to employees of going from 5-day to a 4-day, 40-hour week. Intangible consequences. Numerical economic analysis probably never fully describes the real differences between alternatives. The tendency to leave out consequences that do not have a significant impact on the analysis itself or on the conversion of the final decision into actual money is difficult to resolve or eliminate. How does one evaluate the potential loss of workers' jobs due to automation? What is the value of landscaping around a factory? This and a variety of other consequences may be left out of the numerical calculations, but they must be considered in reaching a decision. Step 4. Identify feasible alternatives. One must keep in mind that unless the best alternative is considered, the result will always be suboptimal. Two types of alternatives are sometimes ignored. First, in many situations, a do-nothing alternative is feasible. This may be the let's keep doing what we are now doing or let's not spend any money on that problem alternative. Second, there are often feasible alternatives such as patch it up or keep it running another year before replacing it. There is no way to ensure that the best alternative is among the alternatives being considered. One should try to be certain that all conventional alternatives have been listed and then make a serious effort to suggest innovative solutions. Sometimes a group of people considering alternatives in an innovative atmosphere or brainstorming can be helpful. Even impractical alternatives may lead to a better possibility. The payoff from a new, innovative alternative can far exceed the value of carefully selecting between the existing alternatives. Any good listing of alternatives will produce both practical and impractical alternatives. It would be of little use, however, to seriously consider an alternative that cannot be adopted. An alternative may be infeasible for a variety of reasons. For example, it might violate the fundamental laws of science, require resources or materials that cannot be obtained, violate ethics standards, or conflict with the firm's strategy. Only the feasible alternatives are retained for further analysis. Step 5. Select the criterion to determine the best alternative. The central task of decision making is choosing from among alternatives. How is the choice made? Logically, to choose the best alternative, we must define what we mean by best. There must be a criterion or set of criteria to judge which alternative is best. Now, we recognize the best is on one end of the following relative subjective judgment. So we have a relative subjective judgment spectrum that is arranged from worst to best. Since we are dealing with relative terms rather than absolute values, the choice will be the alternative that is relatively the most desirable. Consider a driver found guilty of speeding and given the alternatives of a $175 fine or 3 days in jail. In absolute terms, neither alternative is good, but on a relative basis, one simply makes the best of a bad situation. There may be an unlimited number of ways that one might judge the various alternatives. Several possible criteria are create the least disturbance to the environment, improve the distribution of wealth among people, minimize the expenditure of money, and ensure that the benefits to choose who gain from a decision are greater than the losses of one who are harmed by the decision. Next is minimize time to accomplish the goal or objective, minimize unemployment, and maximize profit. Selecting the criterion for choosing the best alternative will not be easy if different groups support different criteria and desire different alternatives. The criteria may conflict. For example, minimizing unemployment may require increasing the expenditure of money, or minimizing environmental disturbance may conflict with minimizing time to complete the project. The disagreement between manager and labor in collective bargaining reflects a disagreement over the objective and the criterion for selecting the best alternative. The last criterion, maximize profit, is the one normally selected in engineering decision making. When this criterion is used, all problems fall into one of the three categories: neither input nor output fixed, fixed input, or fixed output. Neither input nor output fixed. The first category is the general and most common situation in which the amount of money or other inputs is not fixed, nor is the amount of benefits or other outputs. For example, a consulting engineering firm has more work available that it can handle. It is considering paying the staff or working evenings to increase the amount of design work it can perform. One might wish to invest in the stock market, but the total cost of the investment is not fixed, and neither are the benefits. A car battery is needed. Batteries are available at different prices, and although each will provide the energy to start the vehicle, the useful lives of the various products will be different. What should be the criterion for this category? Obviously, to be economically efficient as possible, we must maximize the difference between the return from the investment and the cost of the investment. Since the difference between the benefits and the cost is simply profit, a business person would define this criterion as maximizing profit. Fixed input. The amount of money or other input resources like labor, materials, or equipment is fixed. The objective is to effectively utilize them. For economic efficiency, the appropriate criterion is to maximize the benefits or other outputs. For example, a project engineer has a budget of $350,000 to overhaul a portion of a petroleum refinery. You have $300 to buy clothes for the start of school. Okay, so dito sa fixed input, meron kang allocated na resources. So it's up to you, or ikaw yung bahala mag-decide kung paano mo i-utilize yon at gamitin para ma-accomplish mo yung goal mo. Fixed output. There is a fixed task to be accomplished. The economically efficient criterion for a situation of fixed output is to minimize the cost or other inputs. For example, a civil engineering firm has been given the job of surveying a tract of land and preparing a record of survey map. Another example, you must choose the most cost-effective design for a roof, an engine, a circuit, or other component. For the three categories, the proper economic criteria are: so for the neither input nor output fixed, maximize the profit, which is equal to the value of outputs minus cost of inputs. For fixed input, maximize the benefits or other outputs. For fixed output, minimize the cost or other inputs. Step 6. Constructing the model. At some point in the decision-making process, the various elements must be brought together. The objective, relevant data, feasible alternatives, and selection criterion must be merged. For example, if one were considering borrowing money to pay for a car, there is a mathematical relationship between the loan's variables: amount, interest rate, duration, and monthly payment. Constructing the interrelationships between the decision-making elements is frequently called model building or constructing the model. To an engineer, modeling may be a skilled physical representation of the real thing or system, or a mathematical equation or set of equations describing the desired interrelationships. In economic decision making, the model is usually mathematical. In modeling, it is helpful to represent only that part of the real system that is important to the problem at hand. Thus, the mathematical model of the student capacity of a classroom might be, so capacity is equal to LW over K, where L is the length of classroom in meters, W is the width of the classroom in meters, and K is the classroom arrangement factor. The equation for student capacity of a classroom is a very simple model, yet it may be adequate for the problem being solved. Step 7. Predicting the outcomes of each alternative. A model and the data are used to predict the outcomes of each feasible alternative. As was suggested earlier, each alternative might produce a variety of outcomes. Selecting a motorcycle rather than a bicycle, for example, may make the fuel supplier happy, the neighbors unhappy, the environment more polluted, and one's savings account smaller. But to avoid unnecessary complications, we assume that the decision making is based on a single criterion for measuring the relative attractiveness of the various alternatives. If necessary, one could devise a single composite criterion that is the weighted average of several different choice criteria. To choose the best alternative, the outcomes of each alternative must be stated in a comparable way. Usually, the consequences of each alternative are stated in terms of money, that is, in the form of costs and benefits. This resolution of consequences is done with all monetary and non-monetary consequences. The consequences can also be categorized as follows. We have market consequences where there are established market prices available, extra market consequences, no direct market prices so priced indirectly, and intangible consequences valued by judgment, not monetary prices. For longer-term problems, the most common error is to assume that the current situation will be unchanged for the do-nothing alternative. In reality, if we do nothing, then current profits will shrink or vanish as a result of the actions of competitors and the expectations of customers. And traffic congestion normally increases over the years as the number of vehicles increases. Doing nothing does not imply that the situation will not change. Step 8. Choosing the best alternative. Earlier, we said that choosing the best alternative may be simply a matter of determining which alternative best meets the selection criterion. But the solutions to most problems in economics have market consequences, extra market consequences, and intangible consequences. Since the intangible consequences of possible alternatives are left out of the numerical calculations, they should be introduced into the decision-making process at this point. The alternative to be chosen is the one that best meets the choice criterion after considering both the numerical consequences and the consequences not included in the monetary analysis. During the decision-making process, certain feasible alternatives are eliminated because they are dominated by other better alternatives. For example, shopping for a computer online may allow you to buy a custom configured computer for less money than a stock computer in a local store. Buying at the local store is feasible but dominated. While eliminating dominated alternatives makes the decision-making process more efficient, there are dangers. Having examined the structure of the decision-making process, we can ask, when is the decision made and who makes it? If one person performs all the steps in decision-making, then she is the decision maker. When she makes the decision is less clear. The selection of the feasible alternatives may be the key item, with the rest of the analysis a methodical process leading to inevitable decision. We can see that the decision may be drastically affected or even predetermined by the way in which the decision-making process is carried out. Okay, so we have an example. Liz, a young engineer, was assigned to develop an analysis of additional equipment needed for the machine shop. The single criterion for selection was that the equipment should be the most economical considering both initial and future operating costs. A little investigation by Liz revealed three practical alternatives. Number 1, a new specialized lathe. Number 2, a new general purpose lathe. And number 3, a rebuilt lathe available from a used equipment dealer. A preliminary analysis indicated that the rebuilt lathe would be the most economical. Liz did not like the idea of buying a rebuilt lathe, so she decided to discard that alternative. She prepared a two alternative analysis and showed that the general purpose lathe was most economical than the specialized lathe. She presented this completed analysis to her manager. The manager assumed that the two alternatives presented were the best of all feasible alternatives and he approved Liz's recommendation. At this point, we should ask, who was the decision maker? Liz or her manager? Although the manager signed his name at the bottom of the economic analysis worksheets to authorize the purchasing of the general purpose lathe, he was merely authorizing what already had been made inevitable, and thus he was not the decision maker. Rather, Liz had made a key decision when she decided to discard the most economical alternative from further consideration. The result was a decision to buy the better of the two less economically desirable alternatives. Step 9. Audit the results. An audit of the results is a comparison of what happened against the predictions. Do the results of the decision analysis reasonably agree with its projections? If a new machine tool was purchased to save labor and improve quality, did it? If so, the economic analysis seems to be accurate. If the savings are not being obtained, what was overlooked? The audit may help ensure that the projected operating advantages are ultimately obtained. On the other hand, the economic analysis projections may have been unduly optimistic. We want to notice too so that the mistakes that lead to the inaccurate projection are not repeated. Finally, an effective way to promote realistic economic analysis calculations is for all people involved to know that there will be an audit of the results. Okay, so we have example 1-2. A concrete aggregate mix must contain at least 31% sand by volume for proper batching. One source of material, which has 25% sand and 75% coarse aggregate, sells for $3 per cubic meter. Another source, which has 40% sand and 60% coarse aggregate, sells for $4.40 per cubic meter. Determine the least cost per cubic meter of blended aggregates. Okay, so here is the solution. The least cost of blended aggregates will result from maximum use of the lower cost material. The higher cost material will be used to increase the proportion of sand up to the minimum level, which is 31% specified. We let X equal to the proportion of blended aggregates from the $3 per cubic meter source and 1 minus x be equal to the proportion of the blended aggregates from $4.4 per cubic meter source. Okay, so the computation for the sand balance is flashed in the slide. So x is equal to 0.60. Thus, the blended aggregates will contain 60% of the $3 per cubic meter material and 40% of the $4.4 per cubic meter material. The least cost per cubic meter of blended aggregates is 0.6 times 3 plus 0.4 times 4.4, which is equal to $3.56 per cubic meter. Okay, so that ends our lecture 3. Thank you for watching and see you on the next lecture.
Magbabaksakan dito in 5, 4, 3, 2.
1, 2, 3, 4.
DJ Joanel, sa